Paul, starting off with the market as it is today, it's down some 3% as we speak, even coming after a week where we've kind of had some good news, a bit more of a dovish Fed, oil stabilizing and a trade truce. Do you feel like markets are overreacting to the downside at the moment, a bit overly bearish or not?
Look, I think we're in a period of extended volatility, and we need to start to understand that that's the new normal for now. We've had periods of relatively low price movements. We're now dealing with back and forth on whether or not we'll get to a trade agreement in China. That's going to hang over the market, whether or not the Fed is going to tighten, how much, how quickly. We're also looking at some economic signals which suggest that maybe the economy is slowing a little bit. So all of this, as it goes through, and is processed, is going to create, swings in the market. And we're coming off periods that have been relatively tranquil in price movements. And I think this is closer to a more normal environment than what we've experienced previously.
We've had some big bank CEOs on earlier today, and they've been speaking at the conference. They're remarkably relaxed about the state of the US economy, and yet their own stock prices down 4 or 5% today. Do you get reminded at moments like that of times like 2006, 2007, when money managers and bank CEOs didn't quite see around what was to come?
Look, right now, everything we see in our engagement with CEOs, boards of directors, is people are leaning in, they're not leaning away. They're continuing to pursue their strategic initiatives, objectives, and they're not afraid to commit significant sums of capital. So that level of confidence and willingness to transact remains the same as it was previously. Having said that, we're long in the tooth on this economic bull market. It's inevitable that we'll hit a slowing at some point. The Fed clearly is seeing certain signs that are causing them to suggest that they may go slower with the rate hikes. So like everything, you need to be cautious, but we're very constructive in the current level of activity.
And so let's talk about that then, your core business with M&A. Does this market volatility worry you that the levels will drop off? We've had a pretty good run for M&A, particularly since the 2016 election. Are we due a pullback, whether it's because of market volatility or other factors?
I think you need to deconstruct it into a couple of parts. First of all, the long-term outlook for M&A is quite positive. We're dealing in a world that is speeding up, not slowing down. There's more disruption, technological dislocation. Increasingly, companies need to be proactive in how they manage their portfolio. That's not going to change. So all else equal, we see higher highs, lower lows for M&A. Having said that, we have a business cycle that's not being repealed. So there are going to be ups and downs, and there will be pullbacks. Volatility does have a muting effect on M&A because it's harder to agree on price terms when you're dealing with currency movements, price of the acquirer, price of the bidder. So it's difficult to sometimes bring these deals to fruition, but ultimately most deals find a way to get done once you sort of wade through the volatility. Short term, it's an issue. Longer term, not particularly concerning.
Should just acknowledge for our viewers, the Dow is, of course, down over 750 points as we speak and continue this interview. Paul, a lot of people assume that trade wars are bad for economic activity and therefore bad for M&A. Some, though, saying that that's not true for M&A itself. It could drive cross-border activity. What's your stake on that?
Look, the issue with the trade discussions today is no one knows where we're headed, and no one knows how this uncertainty affects behavior and potentially accelerates an economic slowdown. So once we have clarity on what the rules of the game are and the markets have an opportunity to adjust, we see M&A continuing to move forward. But in this period of uncertainty, it's difficult to commit as companies are trying to figure out their supply chain, figure out their commercial relationships. There's just too much uncertainty, and uncertainty is never the friend of getting deals done.
I want to ask Paul a bit more about your business. You left Morgan Stanley 2012 after nearly 30 years there, and now you've been operating a smaller independent firm for the last sort of 4 or 5 years. Over the last 20, we've seen about 20 percentage points of market share in M&A shift from the bulge brackets to the independents. Why has that shift happened? Have you found it easy to operate as an independent and perhaps poach talent from former employers and their rivals?
Well, we've added an extraordinary number of very senior, very talented individuals to our platform, and that really is what all of this is about. If you can get the best people who want to operate on smaller platforms, and if clients are embracing smaller independent firms because they can get the personal service, the absence of conflicts, the freedom to confide in and divulge, their innermost concerns, and you have capabilities that are equivalent to a big bank, then that's really the sweet spot. And what we're seeing is more and more clients are responding to this type of platform. That in turn creates more opportunities for us to hire from larger firms, and it just feeds on itself. So we've enjoyed significant growth in headcount, also in client mandates, and our reputation is benefiting from the interplay of those two.